Hi guys, good afternoon. Can you confirm my audibility? Guys online, can you confirm my audibility? Guys on YouTube, can you confirm that you can hear me? All right, thanks for confirming, Amani. So there are a couple of more mock answers I'm yet to receive. So far I have received the mock answers of Amani, Yamin, Azmat, Shanuri. Zainab, will you be sharing your mock answers with me? I've shared you the question paper. Hafil Karim, hi. I think this is the first class I'm seeing you. If you are willing to attempt the mock paper that I've shared, you can reach out to me. You can share your contact number on the chat box. I'll share the mock paper with you on WhatsApp. All right. So we'll be starting shortly. Some technical checks being done. Right. Until then, quickly tell me how's your preparation going and how far y'all are in line with the 30-day plan. So I think by now you all should have completed the theory part, right? Right. So today we are actually going to touch upon a past paper. Okay. So we are going to look at the March June 2022 questions, the question paper. So what happens is now we don't get the past papers from every session, rather we get the sample questions, what could have appeared in the exams, right? So that's why we have a combination. So March, June, then we have September, December, right? That's how the past papers go, right? So today we are actually going to look at March, June 2022 because this question paper, I mean, the sample question paper is a little different, right? Not what you usually see and what you usually expect to see, right, in FR exams. So when we discuss this paper, you all will be in a position to understand that, okay, I'm not going to be surprised when I go to the exam, right? Because our expectations are going to be, to face in a paper that is not very complicated, a lot of numbers, very straightforward paper. But that's not always the case. Okay. So after today's paper, you all will be ready for surprises. Okay. So be ready to be surprised. But what is going to be important, what is going to be compulsory, is going to be the 100% coverage of the content, right? 100% content coverage is what is important. Okay, no matter whatever the type the paper is going to be, whether it's going to be a complicated paper, whether it's going to be a non-straightforward paper, or whether it's going to be a paper that you had not expected and never seen, you will not be surprised only if you have completed or covered the entire content, right? 100% content coverage. That's what I would recommend you all to do. Okay. Right. So, those who are online, please log into your practice platforms. Right. I want you all to log into the practice platforms. I hope you all know how to log into the practice platforms. Yeah. So you log into the practice platform. Right. Give me a moment. Right back. Right. So this is how a practice platform is going to look like. Right. This is how the practice platform is going to look like. So this, what I want you all to do is the there is catalog, right? So in that, financial reporting, and under that, ACCA official resources. Under that, past exam library, FR March June 2022. Assign that. Okay. I hope you all are with me. I hope you all are with me. Okay. Then we start this. I am sure you all are familiar with how practice platform looks like now. Right. So this is the first question. Now I've actually taken this question down in Excel, but I want you all to access this question on practice platform, right? Because what I am going to explain is going to be on Excel, because I am going to give you all some additional tips and techniques of how to, what needs to be in your head. I'll be putting it down in Excel, right? So there's going to be a section that should be in your head, right, or somewhere in your paper. But I mean, you can leave it, if time permits, you can leave it in Excel. You're working as well, but something that is theoretical or theory understand that should be in your head is what I'm going to do on Excel, which is why I am going to use Excel. But I want you all to open this up and whatever the questions are, attempt on this. Okay. Right. So this is how it looks like. So you just have to show the workings, right? Okay. So make sure you all attempt it on this. Hi, Shanuri. I have not received a section C yet. I hope I'll be receiving it. Shanuri will be sharing a section C with me, because I have marked your section A and B. I am yet to receive your section C answers. All right. So can you confirm that you all have logged into the practice platform and you all have assigned this question paper? Quickly confirm. Now this is a group entity, right? So what the requirements are saying, the first requirement says, based on the extracts provided, use the pre-formatted table to calculate the following ratios for Venus Group and Venus Group for the years ended 30th June 20x8 and 20x7 respectively. What happens? Here you are supposed to analyze and interpret a group accounts. All right. Then the B requirement 1 says complete the table provided to adjust Venus Court's consolidated profit. 22 Amani, it's March June 2022, right? Complete table provided to adjust Venus Court's consolidated profit for the year ended 30th June 20x8. Now why I'll be choosing, now we are going to do 2 past papers, 1 pre-mock. That's the plan. So I have chosen the past papers that seem to be complicated for the first time students who have not seen it. So I'll be selecting such papers which you all would be surprised, but being surprised at this point is better than being surprised at the exam. All right, so I've selected such questions, which is why it's not going to be the latest papers that we are going to do, but the papers that I feel you need to be thorough with. All right. Right, requirement B. The first requirement says the complete the table provided to adjust Venus Court's consolidated profit for the year ended 30th June 20x8 in order to calculate the profit of Venus Co for that year as if the acquisition had not taken place. Okay, now this requirement says you have to work in reverse, right? So they have given consolidated, consolidated performance report is given. Then there is single entity for the last year. But this year there is no single entity. So what they are asking you to do is based on the group details provided, you have to work in reverse and you have to create the single entity of Venus Group as a 30th June 20x8. That's what it is saying. Okay. So your answer should take account of the information provided in the notes. Your answer should also recalculate the net profit percentage. Remember, how many requirements? How many requirements are there? So first, it says complete the table provided. Okay. Right. Open this up as well. Right. What does the requirement say? Right. So requirement A says sorry guys. Right. Requirement A says based on the extracts provided, use the pre-formatted table to calculate the following ratios. Calculate ratios. Okay, let's break down the requirements here. Okay. For the years ended 30th June 20x8, 30th June 20x7, x8 as well as x7, right? They are asking you to calculate both these ratios. Okay. Right. So GP margin, NP margin, return on equity. Equity should include NCI where applicable. NCI to be taken into consideration. Okay. Right. B. 1. Complete the table provided to adjust Venus-Co's consolidated profit for the year ended 30th June in order to calculate the profit of Venus-Co for the year as if the acquisition had not taken place. First, you are supposed to complete the table. Then your answer should take account of the information provided in the notes, right? Focus on notes, right? And then recalculate net profit. Recalculate. So when you break the requirements down, you will be sure that you are not missing out. So what are the requirements? Complete the table. Then you are supposed to recalculate the net profit margin. Based on what? Based on the notes provided. Okay, that is requirement B1. Then B2 says, explain why consolidated financial statements, for example, those of Venus-Co are not comparable to those of a single entity, for example, Venus-Co. Okay. Now, this is kind of a theoretical knowledge that's required, right? Why consolidated not comparable to single entity, right? Not comparable. Not comparable. Okay, so you need to tell why consolidated financial statements are not comparable to single entity. How many marks is this? 3 marks. Since it's 3 marks, you should know at least to bring 3 points. 3 well explained comparisons. Okay, not just bullet points. You all have to have an explained, well explained paragraph there. Then, based on your answers to parts A and B, comment on the comparative performance of Venus-Co for the years ended 30th June 20x7 and 20x8, specifically addressing the managing director's comment. Right. C. Interpret. Okay, so these are the requirements of this question. First requirement, calculate ratios for both 20x8, 20x7. Then you have to consider NCI there. Requirement B, there are 2 requirements, sub-requirements there. First sub-requirements requires you to complete the table by focusing on the notes and to recalculate the net profit margin based on the recalculated numbers based on the table that's given, right? That you have worked on. Then second sub-requirement says, explain why consolidation and single entity are not comparable. right? At least 3 points there. And the requirement C says interpret. Okay, that's the requirement in a nutshell. Now, just to look at the tables that are given, okay, we see that there is a pre-formatted table given for GP margin, NP margin, return on equity. When this is told, there is a working section given and there is the answer section given. So you need to show the workings as well as your answers. Okay. So GP margin, NP margin, I'm sure you all know the formulas right now, what the formulas are supposed to be, right? GP margin, NP margin, return on equity. All right. And then you should use this table, part B1, the table, adjusted profit, then Venus Co consolidated profit for the year is given. Then adjustment 1, deduct Luto Co's post-acquisition profit. Now the adjustment 1, they have given as an example. Okay, now this is how the adjustment needs to be done is what they're saying. Right? So adjustment 2 to be completed, note 2, note 3, note 4 is where the adjustment 2, 3, 4 comes in, and that would give you your Venus Co single entity net profit. Now what you're supposed to do here? What you're supposed to do here? Here you are supposed to see, okay, what are the consolidation impact? Because consolidated financial statement already would have considered those impacts. Now you should know what has been the impact and to eliminate that impact accordingly, either by adding or deducting. All right, that's what you're supposed to do. Are you all with me? Are you all with me? Is that clear so far? I want to make sure that it's clear, the requirements, you're understanding it properly. Is that clear, guys? Is that clear? Right, okay. Then B2, B3 and C is writing, okay, based on what you have understood. Okay, right. So now I'll be closing the both these and I'll be opening the Excel, right? Now I'll be doing the working on Excel. All right. Right. So let's start looking at the question. The question says, this scenario relates to 4 requirements. We already saw what the requirements are. What's the requirement when you open up a question paper? First, you read and understand the requirement. Only when you read and understand the requirement, you'll be able to read the question in a way that fits in the requirements. All right. So this scenario relates to 4 requirements. Venus Co acquired 70% of the equity share capital of Luto Co. It's only subsidiary on 1st of January 20x8. 1st of January 20x8. Right? On reviewing the consolidated financial statements, the managing director of Venus Co was disappointed, commenting that he had expected to see higher gross profit for 20x8 due to the receipt of discounted purchases from Luto Co in the post-acquisition period. Why? Because of the discounted purchases, the benefits that the company would have received by acquiring Luto Co. He has remarked that the acquisition of Luto Co has not had the positive impact he expected. Now, that is the managing director's comment. Now, where is it going to be relevant? C, right? C, that's going to be relevant. Based on answers to part D, C. A, B1, B2, and C. Based on your answers to parts A and B, comment on the comparative performance, specifically addressing the managing director's comments. You need to address these comments specifically. What are comments? Expecting higher GP margin due to the discount purchases and remarking that acquisition had not had the positive impact. Okay, that's what you need to consider and comment based on that. Be very specific. When you're reading the requirement, be very specific to understand what the requirement says. Okay, right. Now let's move on to the first item or first set of questions. A. Right? A requires you to identify GP margin, NP margin, return on equity for both X8 and X7. Okay, both X8 and X7. So let's open another sheet here, right? 20 X 8, 20 x 7. What do they require? They require you to do the GP margin, NP margin, and return on equity, right? So those who were there in the live class, I hope you all remember return on equity and return on capital employed would have two different formulas. Okay. Now return on equity is going to consider profit after interest and tax, which is going to be net profit in other words. But if it is return on capital employed, it's going to be profit before interest and tax over the equity, right? Right. So let's keep one area for work here, formula, right? 20 x 8, right? GP margin is going to be GP divided by revenue. NP margin is going to be NP, profit after interest and tax, divided by revenue. Return on equity is going to be NP divided by equity, right? That's going to be the formulas you need to know. Okay, right. 20x7. What's the GP of 20x7? They've given it here, right? 20x7 GP, this divided by revenue. Okay, 20x7. 20x8 GP, this divided by this, right? NP margin is going to be net profit divided by this, right? Equals net profit divided by revenue. Return on equity, net profit over equity. Net profit divided by equity, considering NCI. You have to consider NCI also. So you have to take the total. Okay. Equals net profit divided by equity. Right. Is that clear so far? Is that clear? Is that clear? Do you understand? That was a very straightforward question, isn't it? Yeah? Is that clear, guys? Quickly confirm. Please confirm quickly. Right. Straightforward question. Now that's a straightforward calculation, right? Why? We know the formulas. If we know the formulas, we know how to tackle those formulas, right? So what's important here? To know how the formulas work, right? That's what is important in this case, in case of ratios. Requirement 1, requirement A, done. How many marks was that requirement? How many marks? 3 marks. You got the 3 marks. Was that difficult? Was 3 marks difficult? No, right? So remember, every question would have some easy parts. So do the easy parts first. B. Right. Now the requirement B1 wants you to do the adjustment for this one. Right? You need to do the adjustment for this one. Right? Based on your complete the table provided to adjust Venus course consolidated profit for the year ended 30th June. Okay, now we need to do the adjustments, right? Now you have to take the consolidation. Now this needs to be in your head, huh? Perspective, head theory, right? Then you should understand what should be done to eliminate. Add or deduct, right? The only two options, right? You either add or you deduct, right? To eliminate something. right? Okay. Now, note number 1 is what this is done based on. They've done this based on note 1, deduct Lutoco's post acquisition profits, right? Note number 1 says Lutoco recognized revenue of $5 million in the post acquisition period, which resulted in a profit of $2 million. Meaning, if you look at this consolidated statement of profit or loss, you know that that profit has been considered, right? Lutoco has recognized revenue, so that revenue is also inside the 39,000. Now, the 39,000 includes that 5,000, right? So, if it was single entity, Venus Co, single entity, 30th June X8. If it was single entity, what would have been the case? The revenue would have been this minus 5,000. This would have been your revenue. Okay, now why I am doing that, you'll understand that, right? And what is the GP? GP is 2 million. That's what they're saying, right? So without considering Lutoco, what would have been the GP? That's the GP. 10,500, right? So what are you supposed to do since they have considered? Since Lutoco has considered this 2 million profit as a part of group profit, you need to eliminate that. To consider the group profit, what happens? It has been added, right? Your consolidated statement of profit loss has added that group profit. To eliminate that, you deduct, right? To eliminate that, you deduct. So what have they done? They've deducted, right? What's a consolidation perspective? Considered as a part of group profit. So you have to deduct. They have done that. Deducted 2,000. Is that clear? Does that make sense, guys? Did you understand that? Quickly confirm. If you've understood it, we can move on to the second note. Did you understand that? Quickly confirm. Any questions you all can ask at this point? Do you understand? I want all of you all to respond. First of January 20x8 was the acquisition. 30th June is the year end. So it's not a, it's a mid-year acquisition, right? Is that enough, Azmat? Is that Zoom sufficient? Guys on YouTube, are you understanding that? Any questions so far? Any questions so far, guys on YouTube? Y'all also can, y'all feel a part of the team, and y'all feel free to ask questions, right? Any questions y'all have, I can clarify it for you. Okay? Right, Azmat, I hope that Zoom works. All right. Shall we move on to the second note? Shall we move on to the second note? Right. Note number 2. Since the acquisition, Venus Co is able to acquire goods from Lutoco at a discount. This has resulted in a saving of 500,000 for Venus Co in the post-acquisition period. At 30th June, Venus Co had no inventory that had been purchased from Lutoco. There's been no unrealized profit adjustment. That's what the last line is saying. If there were inventory in the with Venus Co, there would have been the adjustment, unrealized profit adjustment under cost of sales. So they've made it a little easier by saying that there have been no unrealized profit. But what has happened? There have been savings, right? Because now only when it is a group, you will see that they are going to benefit from the discount, right? They're benefiting from a discount only because it is a group, right? That's something that you need to understand, right? So what has happened? What has happened? 500,000 savings has been enjoyed. Had this not taken place, had this the consolidation or acquisition not taken place, had Lutoco not been acquired, they would have not received the discount, right? They would have not had savings of 500,000. So now they have had a savings, meaning positive impact. Now you need to eliminate that positive impact. To eliminate that, what do? You have to deduct that 500,000. Okay. What has happened here? Enjoyed as a benefit of acquisition. Okay, benefit of acquisition. So what do? You have to deduct. Why? It's a savings, 500,000 savings. So you're going to deduct that 500,000 minus 500. Now it is, remember to always see the numbers, whether it's in thousands, millions, whatever that you need to focus on. Minus 500, it's in thousands, so 5 minus 500 is what you need to show there. Okay, is that clear? Is this clear, guys? Quickly confirm, is this clear? Are you clear with this? Okay, so let's use the thumbs up, right? When it's clear, all of y'all do a thumbs up. So I'll be, I'll take it as a confirmation that it's clear, right? Quickly use thumbs up feature to tell me that this note is clear. Only when this note is clear, we'll be able to move into the next note, right? Thumbs up if it's clear. Right, okay. So let's move on to the third note. What you're supposed to do, you're working in reverse. I've been consolidation. Your rote learning, meaning what you're used to reading the theory, you would be used to doing the single entity to consolidation. Okay, if these notes were given, okay, now single entity, that 2 million needs to be removed. So you know all that, right? So keep that in mind. Okay, this is what has happened, and you work in reverse, meaning elimination. Okay, that's what you're supposed to do here. Third note. The consideration for the acquisition consisted of a share exchange and an additional 5 million to be paid on 1st of January 20x9, a deferred consideration. Venusco has a cost of capital of 8%, which is equivalent to a discount factor of 0.926. Okay, now there is a deferred consideration. When there's a deferred consideration, what happens? When there's deferred consideration, now what are we looking at? We're looking at consolidated statement of profit or loss. What's the impact the deferred consideration would have had on the consolidated statement of profit or loss? What's the impact? First you take the present value, then you unwind, right? There's something called unwinding cost. Yeah, deferred consideration, unwinding cost. You take the present value, then you unwind that value, right? So what happens here? 1st of January is when you are supposed to pay. When is the year end? 30th June. When was the acquisition? 1st of January 20x8. 6 months into acquisition was your year end. So 6 months. 6 months of that unwinding discount would have been taken into consideration. Right? That statement of profit or loss would have had the unwinding of discount for 6 months. Okay? Let's do the calculation. Right? So what they are saying? 5 million. 5 million. What's the discounting factor? 0.926. This is a present value. Okay. Into 0.926. Okay. This is a discounting factor. So 5,000 becomes 4,630. Now we are going to unwind it. How do you unwind? This into the discount rate. Sometimes you would have taken 370 as it is. But is the 370 included? No. Accrue evenly. So only 6 months base unwinding discount is given. Right? That is the only unwinding discount that would have been a part of the consolidated statement of profit or loss. This into 6 divided by 12. 185. Now what has happened? Unwinding discount, what is it? It's an expense, right? Finance cost. So what they have done to arrive at the profit, they would have deducted that, right? They would have deducted this value. So if they've deducted it, to eliminate, what do you do? To eliminate that, what do? You are going to add it back. Okay, you are going to add it back. All right. Unwinding discount taken for 6 months. This has been deducted, therefore you are supposed to add it back. How much are you adding back? There you go. Okay, is that clear, guys? Is that clear? Quickly thumbs up. You'll understand that. Quickly use the thumbs up feature and tell me whether you understood that or not. Was that clear? Right. I'm receiving a couple of thumbs up. I'm not receiving a couple of them, but I'm assuming that all of you all have understood because I'm not asking questions. I'm assuming that all of you all have understood. All right. Okay, so let's move on to the next note, the fourth note. Right. The fair values of Lutoco's assets at acquisition were equal to their carrying amounts, except for an item of plant. This plant had a remaining life of 3 years at the date of acquisition. Its fair value was 900,000 above its carrying amount. Venus Co's assets are held at historical cost. Now what happens? Now what happens? What happens now? There is a fair value adjustment, right? Consolidation, fair value adjustment. What happens in fair value adjustment? When you do fair value adjustment, you are going to do the excess depreciation. So that profit or loss, the consolidated profit or loss is going to have excess depreciation included there, right? How much is that going to be? 900,000 divided by 3, right? 300,000. Or let's do it in thousands. 900 divided by 3, 300, right? But do you think that entire 300 is there in the profit or loss? Do you think that 300 entirely is there in consolidated statement of profit or loss? No. Only 6 months depreciation is in the consolidated statement of profit or loss. Why? 1st of January 2028 purchase, fair value adjustment done there. 6 months into the year, there is a year end. So 6 months depreciation is what is considered. So you have to time a portion. So remember to look at the details, right? And be very particular to work on the details and specifics. All right. So had you all not done the time apportionment, wrong. Okay. All right. So what do? Depreciation deducted, expense, right? Deducted. So eliminate that. What do? Add. Right. Excess dip. What happened there? Excess something wrong. Excess depreciation considered for 6 months. That's a consolidation perspective. So you have to add that back to eliminate. Okay. So how much are you going to add? How much are you going to add? Add that. There we go. Venus Co. single entity net profit. Sum. Take this all the way down. And this is the This is Venus Co. single entity net profit. Clear? Was that clear, guys? Do you understand that? Do you understand how we arrived? We did the reverse working, how we arrived there. Do you understand that? Clear? If that's clear, we'll move on to the net profit percent NP margin working. Right. Now, while comfortable doing a reverse working, have you all ever tried a reverse working so far? Did you all think that the examiners could go to the extent of giving you all a reverse working? Did you all think about that? No, right? But now will you all think about it? Will you all be surprised when I go to the exam and see such a different question? What does it require? It requires exactly the knowledge, right? The theory knowledge, the 100% content coverage knowledge, right? Had you did the content coverage, you would have known, okay, they've consolidated. Okay, this is how the consolidation would have happened. Okay, so now what I'm supposed to do? How I'm supposed to eliminate that? So what exactly I did, the consolidation perspective should have been in your head if you would have done 100% content coverage. Clear, guys? Are we good to move further? Are we good to move further? Yeah. Right. Now, this is the net profit. Venus course single entry net profit is given here. Now, we are going to do the NP margin recalculation. How do you do it? Net profit divided by revenue of Venus single entity. Now, you understand why we did this adjustment here, right? This is the figure you are going to use and not 39,000. Why? Because the 39,000 includes 5,000 as a part of acquisition. So you have to eliminate that and consider that as the Venus core single entity figure. Do that. So you see that? Do you see that? Percentage. There we go. Right? 22.46. What were the percentages initially? NP margin. What was the NP margin? 27.81 became 25.13. Now what is it? 22.46. Single entity is worse. Yeah. Acquisition is better. Because of acquisition, there is still 27.6 better than last time's NP margin. So this is worse, right? Now you have to understand. Okay, 27.81 became 25.13. But without considering the acquisition, it's worse, 22.46. So difference is much. 27.81 has become 22.46 now. So is the acquisition a problem? No, because of acquisition, because of the Luto because of Luto's performance only, they are somewhere holding on. Okay. Now when you're doing the interpretation, I'm just giving the tip right now itself. When you're doing the interpretation, you will be working on as many aspects as possible for recalculated figures. Okay. So GP margin, we have that recalculation, right? This divided by this. So you need to be prepared to comment on each of these, right? 34 becomes 32, but without considering acquisition, it becomes 30.8, right? NP margin, we just saw, right? We just saw that figure here. Already taken it. Net profit over equity. We go here. Okay, now that's a question because we don't have enough information to understand whether how much equity includes the equity of the subsidiary. But remember, how you will understand is now equity, the share capital, share premium will not change. That share capital, share premium will remain unchanged, right? It's going to be the parents only that will be considered, right? So this, we are assuming it's parents. The other component of equity, I mean retained earnings changes, right? 21,000. So here we have the, but we don't exactly know what. Now these are the figures. Now what they've given here are the figures that we have to assume are the only operating expenses, right? Because if we don't have further information, we assume that these would be the operating expenses, and we consider that, right? We consider only those as the operating expense figures. Okay. So what are the operating expenses given here? What are operating expenses given here? There is unwinding discount, there's excess depreciation. Those two have been considered. But how about the rest of the figures, right? The rest of the figures not been given very clearly. So what we'll do is uncertain. There's a lot of uncertainty around that. So the NP over equity is going to be a little bit of a question. Return on equity is going to be a little bit of a question. But if you are confident enough, or if you are brave enough, right, and if time permits, if you can go to that extra extent, right, where you comment on the insufficiency of information to comment on return on equity, but with the assumptions that I'm assuming that there's no change, and you consider that those changes and you do the working, that might be helpful. Okay, that might be helpful, right? So what happens here? 17,000 becomes 21,000. What's the difference? 17,000 becomes 21,000. What's the difference? There's a difference of 4,000, right? Retained earnings has changed by 4,000, but 9,800 is the group consolidated profit, right? Meaning there would have been some dividends that would have been paid as well, right? Some retained earnings, some payments out of retained earnings, right? That's why we see that exactly 9,800 is not what is increased here, right? Therefore, we are not going to touch upon that. But if you are brave enough to comment on that, you are almost at the prize winning level assumptions, or you are making prize winning level interpretation, right? You don't need to, when you're interpreting, you don't need to, sometimes there could not be figures, right? You can't find figures, but at least commenting on why the figures would not be available is also going to add value, right? For example, the return on equity also would change, but because the information is insufficient, we can assume that share capital, share premium remains the same, but retained earnings changes is not very clearly given. Therefore, commenting on that ratio is not going to be very clear, but give your assumption, right? Only if you're brave enough, but not something that you have to do. As far as you are able to figure out, able to respond to the questions or to the figures that are there, that can be seen, that are evident, that's good enough. Okay, right. So now we have recalculated figures of GP margin, NP margin, which we can use to do the section C, right? Interpretation. All right. Okay, so B1 is done. Now you need to explain why consolidated financial statements are not comparable to single entities, right? Why it's not going to be comparable? 3 points, 3 good points. 3 good points. So always you all have to do the expansion. Expand it. 1. Right, this has been done, right? Then 2. What's the requirement 2? Why not comparable? Okay, now to do that, again, you need to write in full paragraphs, right? Complete paragraph. But what I'm going to do is I'm going to give you all a comparison, right? That's for your benefit. Single entity or consolidation financial statements versus single entity, right? What's going to be point 1 that we will be commenting on? Consolidated financial statements is going to have income and expenses of subsidiary included. Only income or income and expenses of only the company, only single company included, considered, right? Clear? Income expenses of subsidiaries are also included here, only single entity is included, right? Second point, let's comment on asset and liabilities. Assets and liabilities of subsidiaries included. Assets and liabilities of only single company is considered. When you're writing, don't worry too much about the spellings. Spelling mistakes are not going to cost you anything. So if you feel you've done spelling mistakes, go ahead, nothing to worry. Okay, right. What's next? Intra group transactions are eliminated. No elimination of any transactions. What does it require? It requires, mainly it requires you to have the theoretical understanding, right? Right. NCI, or non-controlling interest. Is considered and is a part of calculations. Single entity, no non-controlling interest. Right? Then you can go on, there are many points that we can touch upon. Fair value adjustments, of subsidiary considered, no fair value adjustments of external companies. How many points do we have there? We have 5 points, right? You all should be able to expand those points. Is that clear, guys? Is that clear? How to answer that question? Not difficult. Just that you need a clear understanding of how consolidation is different from single entity and what are the transactions that take place. Keep that in mind and you can tell, okay, because of these reasons, you can't compare. Okay, because of these reasons, you can't compare. That's the conclusion that you're going to give. Clear? Is that clear, guys? All with me? Is that clear? Quickly confirm. Is that clear? Great. Right. Okay, so now we are moving into the section C, right? Okay, now section C, we can look at, now from this itself, we see, right? Now, what is section C requiring you to do? It requires you to give a comment on comparative performance and you have to address MD's comments. What are the two MD's comments here? Higher GP margin. Okay. First, you need to comment on comparative performance, right? So here, how you are going to do the commenting is consider the consolidation impact and contrast against the performance by excluding the acquisition or consolidation impact. That's the first thing that you have to do. When you're commenting on comparative performance, what are you supposed to do? First, you are supposed to touch upon the consolidation impact, right? All that we saw, how the NP margin changed, right? The NP, we saw the margin changing, right? So when we looked at the change, we can consider that consolidation impact, how 5 million revenue has been brought in by Lutoco, right? First we touch upon, when we are doing that, first we touch upon the revenue, right? 32,000 was Venus Co's revenue. This year, out of 39,000, 5,000 has been Lutoco's revenue, right? And on which means 34,000 is the revenue of Venus Co. But out of that 34,000, last year 32,000, the change has not been that great. Lutoco has brought in a higher performance. Lutoco has 5,000 against 2,000 of Venus Co. Now that Lutoco, remember, only 6 months performance has been considered, right? The revenue of Lutoco is not a full year revenue. That 5,000 is only 6 months revenue, right? Why? Because when you're taking consolidated statement of profit and loss, it's going to accrue evenly, and you're going to consider only the elements that are going to impact during that particular period, particular year end. Mid-year acquisition only 6 months. That 5,000 is only 6 months performance. If it was 1 year, the performance would have been much higher, right? The contribution of performance would have been much higher by Lutoco against a smaller performance of one entire performance of Venus Co, being 34,000. Okay, and you have to contrast. Now, comparison is where you bring in that 5,000 6 months, 1 year, then contrast it against the Venus Co's performance, 34,000. Okay, right. That's one point that you touch upon. Second point that you touch upon is going to be the GP level, right? GP level. Now, GP level, first you are going to show the differences in the GP. Now, 2,000 GP has been brought in by Lutoco, right, out of 12,500 GP. Last year's GP of Venus Co's single entity or single Venus Co alone was 11,000. But when you eliminate the 2,000 GP brought in by Lutoco, it comes down to 10,500, meaning Venus Co as a single entity has performed worse than last year's performance. And that 2,000 of Lutoco is only for 6 months. Had it been for more than 6 months, it would have been much higher. Right? Had they considered for a year, it would have been much higher. Okay? So meaning at GP level, Venus Co from single entity perspective has done a bad job, a bad performance. Right? It has not been a very strong performance, or it has been a worsening performance. Contrast. Why do you compare? 2 million brought in, you remove the 2 million and you contrast with the Venus Co single entity performance. Then you touch upon the GP margin. Now you don't just comment on GP change only. You can comment on GP change. You can say the GP change has been 10,500, which is 500 below. Last year was 11,000. So you can do a little bit of a financial analysis there. But mainly touch upon these figures that you have calculated. Right? 34.38 became 32.05 with consolidation. But when you eliminate that, now this comparison, right, commenting by considering the consolidation, then you contrast by eliminating. 34.38 becomes 30.88, meaning margins also have been dropping, right? Margins also have been deteriorating. Okay, so that you can show through these figures. Clear? Then you touch upon the NP margin figures that are given here, right? NP margin figures, how that has changed. 27.81 became 25.13. That's the comment by considering the consolidation impact. And eliminating it is 22.46, meaning 27.81 become 22.46 at Venus from Venus perspective, which is worse. And then you consider the numbers also. What was the last year's Venus Co's NP? It was 8,900. What is this year's Venus Co's NP? 7,635. Venus Co as a company has performed worse, performed bad. Only because of Lutoco, the performance at least has been higher. That also only 6 months consideration of Lutoco's performance has brought in the performance at this level, right? So meaning the acquisition is a valuable acquisition, right? You gather all these evidences, all these figures in order to address the comments of the MD. Will be coming there, all right? Okay. And then after that, you also can comment on the the synergies. Now they're saying the cost savings have been brought in, right? 500,000 cost savings have been brought in. So that's a synergy, right? When two companies come together, there's going to be synergies. Now, since it's just the first year will not see the operating cost changes, but eventually they'll even see the operating cost going down, right? So all that will be evident only when it is considered further, right? Remember that you need to make sure that you consider all the elements that the consolidation is going to impact and how against a single entity consolidation works better. Clear? Right. Now we'll look at the MDs. Now that entire explanation you give, each point you touched upon, now you address MD's comments. What is MD's comments? Now let's see how stupid MD is, who does not know, who does not have financial knowledge, and he is an MD of that company, right? Okay, what is the MD saying? See higher GP margin due to receipt of discounted purchases from Ludoco. Stupid, no? First comment says expected higher GP margin due to the discounts received for intra-group purchases. That's the first comment the MD is making. So what is going to be the counter argument there? You need to explain the MD. Mr. MD, look, when you take a group, a consolidated financial statements, you don't consider intra-group purchase, you eliminate that. So GP margin anyway is not going to have the impact of the intra-group purchases, right? Whether there was a discount or not, there is not going to be an impact. Why? Because you are supposed to eliminate intra-group transactions. When you eliminate, how will the GP margin change? How will the MD expect to see GP margin changing, right? So intra-group impact, acquisition impact will not be evident at GP margin level. So you need to explain to MD by bringing in the financial knowledge that you have, that when you take consolidation as per IFRS 10, right, or as per IFRS 3, you are not supposed to leave the performance of the intra-group transactions in the financial statements. Rather, you eliminate the intra-group transaction, and when you eliminate that, anyway that impact is not going to be shown in GP margin level. So MD will anyway not be able to see that. That's the first counter argument. What is the second comment? MD says acquisition has been a bad decision. That's what the MD says, right? Acquisition has no positive impact, right? Now you have to know whatever the interpretation you've done there, the comment on comparative performance, you use all that and you say, Mr. MD, look again. Had the acquisition not been there, this would have been the performance and this would have been the margins of your Venus Carco. Only because of acquisition, only by considering 6 months performance, we are seeing a better performance here. Had we taken 1 year into consideration, this would have been a much higher performance, right? So acquisition is what has saved you, what has saved your reputation. Had the acquisition not taken place, you would have, been at a much worse position. Yeah. You don't need to be so harsh, right? Remember, when you're interpreting, that was just to give you an understanding how you all are supposed to interpret. But when you're interpreting, always have a neutral mindset. Okay, neutral. Look for conclusive, interpretations. Meaning, look at information that can make that interpretation conclusive. If it's not conclusive, remember when you're interpreting, if you see that the information is insufficient to comment on the conclusion, you can say this is inconclusive because of the insufficiency of information, because we require this information, right? Or when it's conclusive, you can say, in conclusion, acquisition has been a better decision made by the organization, and this acquisition is definitely going to bring in more benefits in the future, because when 6 months performance can be this good, the future performance can be much higher, and that's going to benefit the organization much better. Okay, is that clear? Is that clear, guys, how to do the interpretation? Is that clear? Where have we eliminated that 500,000 from, Azmat? Go down. That 500,000 is a part of your NP, right? What was the NP? 9,800. That becomes 7,635. So that 500 has been considered as a part of your operating cost, not as a part of your cost of sales. Okay. It becomes a part of your NP change, not a part of your GP change. Clear? Right. Right. So are you all in a better position to interpret? You will find that question little, eye opening and something to, see things from a different perspective, right? Are you all ready to not be surprised when you all go into the exam hall? Are you all ready to be not surprised? Right. What is required? What do you need to have? You need to have a content, 100% content coverage in your head. Okay. To answer any questions, if you have covered the content 100%, you definitely are going to answer better. Okay. Right. So with that, we are good to move to the question 2. But before we move to the question 2, let's take a short break. A 15 minutes break, and let's come back and start the second question. All right. All right. So moving into the second question. Guys, are you all here listening to me? Guys, are you all here listening to me? Am I audible? Right. So same question paper, March, June 22. So I asked you all to log into practice platform, Umar. Please log into practice platform. Right. It's March, June 2022 paper. We just finished the first question. So now we are moving into the second question. Practice platform. It's a past paper. Okay. All right. So let's quickly look at the requirements. Let's go back to this. There we go. Now here you see there is an Excel option, right? They have given you the Excel option to answer. Right. So there's an Excel option and this print code, right? Did you log into the practice platform? Yeah. Yeah. ACCA official resources. Right now, what does this requirement say? The first requirement says, requirement A says, prepare the statement of profit or loss for Printco for the year ended. B says, prepare the statement of financial position for Printco. Right. So it's both are preparing the financial statements. All right. Now these statements are going to be dependent on the loans. Not loans, notes, right? Okay. So always remember, any questions about financial statements, you always start from the notes, right? Notes is where you start. Okay? Always a notes section where you start. So always you start reading the notes and then you respond to each of the notes. Okay? Now when we go to these notes, why I have selected this paper again, you'll understand. First was because of that first question being an unconventional question, and second question also being a little unconventional, although it is a single entity question. But what you are going to see here is going to be different, not something that you always see. Okay, right. So let's just read the notes together. The first we'll read the notes and we'll be rereading the notes when we go into the Excel. The first note says, on 1st of January 20x2, Printco raised funds of $30 million. Raised funds. Now, funds can be raised from two ways. Capital, when it comes to capital structure, it can either be debt or equity. Okay? The full amount was recorded in the nominal ledger as a bank loan. Debt is what they've recorded it as. Okay? The funds actually consisted of a bank loan of 16 million and 14 million from the issue of 7 million ordinary shares. Meaning there is a split between the debt and the equity. All right. Interest is payable on the loan at 5% per annum, and accrual for 6 months interest has been included in trade and other payables and recognized as a finance cost. However, the calculation of interest was incorrectly based on the nominal ledger loan balance at 30th June 20x2. Right. Now, what happens here? What have they given? The trial balance has some errors that needs to be fixed. Right. The trial balance figures have some errors that needs to be fixed. Again, not a straightforward note where they give you an information, you pick the information, start working. They have done the wrong working. You have to figure out what's wrong in that and correct it. Okay. Second one, inventories at 30th June were initially valued at a total cost of 5.7. This includes 700 units with a cost of 1,400 per unit. In order to sell these items, they need an additional process that costs 400 per unit, at which point they can then be sold for 1,600 per unit. Now you go to trial balance and see the inventories. Where is the inventory option here? Inventory 6,850, right? As at 30th June 20x1, 6,850. In this, what they're saying, inventory is initially valued at a total cost of 5.7 million, right? Now that 6.8 million has its 5.7 million. This includes 700 units with a cost of 1,400 per unit. Now what you need to understand here, what they have done in this case is they have considered the inventory at the cost. Right, but what does the what does IAS2 say? Inventory needs to be lower of cost and net realizable value, right? Okay, so 700, 1,400, how much is that going to be? Plus 1,600 minus 400, which is the NRV into 700. What's that going to be? Right, so you need to get those figures and you have to take the lower and value at it accordingly. Okay, right. So likewise, we understand that all these requirements are going to have some sort of errors that needs to be fixed in order to get those figures to fill in our financial statements with. Now let's go to the Excel. Okay, guys, can you hear me? Are you all with me? Guys online, please do a thumbs up if you all can hear, if you are with me, so that we can start working on each of these. Right, okay, thanks for confirming, Shenuri. Right, so now we'll take slightly different. Again, there are certain items that I'm using the Excel for that needs to be in your head, right? Not on the paper, right? Because time won't permit you all to put everything on the paper. Working note number, right? That's the first thing that you do. Then the standard affected or applicable standard sounds better. Right, applicable standard. Then you have to see what has been done. What has been done. Then you have to see what should be done. So when you take the what has been done and what should be done, you would know what needs to be the adjustment. Okay, clear? Right. Let's start with note 1. What does note 1 say? Funds being raised. Full amount recorded in nominal ledger as bank loan. 30 million recorded as bank loan. What has happened? Bank loan. Okay, what is the standard? What's the applicable standard here? Although not explicitly, but financial instruments, right? Debt equity, right? Okay, not explicitly though, but there is IFRS 9 involvement here. Okay, right. What has been done? Bank loan has been recorded as 30,000. And then what else has happened here? Okay, equity, there has been no equity as per this. 0. Now what else are they saying? An accrual for 6 months interest has been included in trade and other payables and recognized as a finance cost. However, the calculation of interest was incorrectly based on the nominal ledger loan balance as at 30th June. Right. What have they done here? They have 5%, finance cost. Okay. Financial statement. Which financial statement has it affected? SFP, SFP, SPL, right? Finance cost. How much finance cost? Into, is that 5% or 6 months, right? They are saying 6 months, okay? 5% into 6 divided by 12. Okay, they've recorded that also as finance cost. And what else are they saying? Trade and other payables. Trade and other payables. That also has been the same value. What should have been done? What should be done? 16,000 is bank loan, right? 14,000 equity, right? Is that clear? Is that 14,000 equity, right? 14 million from the issue of 7 million $1 ordinary shares. Now, equity also, there are two components of equity. What are two components? Share capital and share premium, right? Share capital 7, share premium 7. Okay, right. That's how you are going to focus on your statement of financial position. You can do the workings in any way that you want. No. That's what I'm saying. Those are all in your head. Huh? Now, the financial statement impacted the applicable standard, what has been done, what should be done, ideally should be in your head. Okay, I am showing it. What is in my head, I am showing here, so that it helps you to learn. But what you are supposed to do, only the adjustment, right? Do the adjustment, you'll be doing all these workings little, somewhere. But if you use this structure, it's okay if time permits, right? If you are like, really strong with timing, can do this, but not necessarily. Okay, right? So what is going to be the finance cost? Now this into 0.05 into 6/12. That is going to be the finance cost, and that would be your trade and other payables, right? So what's going to be the adjustment now? What's going to be the adjustment? This minus this, right? You can just there we go. So what needs to be done? In trial balance, you have to now if you go to trial balance, what happens in trial balance? What's a bank loan given here? Note number 1, bank loan given here, 30,000 is given here, right? Trial balance will be taking only 16,000 there. When you transfer to financial statements, statement of profit or loss and statement of financial position, you have to record the actual figures there. Okay, now this is a working note. You can, even if you want, you can start working on your statements also together, right? Statement of financial position. So I'm sure you know how to write all these drafts. I'm not giving you all exactly how the format should look like, but I'm just touching upon that. And I'll be taking all the relevant items under those relevant headers. Okay. E and L, E, non-current liability, current liability. Around, usually they give around 5 notes, 5 to 6 notes, right? Maximum 7, right? But be prepared. Okay, right? Now what happens here? Now okay, under equity there is share capital, there is share premium. So what needs to happen? Share capital, you have to record 7 million there. Share premium is going to be 7 million. Then non-current liability, there is going to be bank loan. You'll be recording 16. Okay, that's what you're recording there. Current liability are payables. What's the figure they've given here under payables? Where is payables? Trade and other payables, right? Trade and other payables. This is the item. 4,170. Now you need to do the adjustment based on this 4,170. You take this, you always give reference if there is possibility, then you deduct whatever you are supposed to deduct, right? 350. All right, why did we deduct 350? Why did we deduct 350? Yeah, revenue, cost of sale, GP, then we have admin expenses, right? What are all the workings that you're supposed to do? Admin expenses required. What's the other expense types they've given here? There is distribution cost and finance cost, right? Distribution cost, finance cost.
So right. The operating. You don't need to give the operating profit.
Not necessarily. There is nothing required here for operating profit or loss, right? If there was a ratio, you only show it where necessary. Ratios can, yeah, they can ask the interpretation of this. So remember, when they require, first question was interpretation of group. So if they give you to interpret group, you will have to do the individuals, a single entity as the calculation. If single entity is the interpretation, then group is going to be the calculation. Okay, that's something that you need to remember. All right.
So if single entity is interpretation is easy, so we can spoil group.
Single
entity comes with that it We can swap from the group.
Yeah. So lucky, that depends on your luck. So you need to be prepared and ready with the 100% content coverage. Now you have missed a little bit what we discussed, but it's on YouTube that you can go and watch, right? Whatever you missed. Easier way while traveling back, you can put a headphones and look at the first question that we discussed. Okay. Right. Now finance cost. What's a finance cost given here? There you go. This is the finance cost, 750 minus how much? Minus 350, right? So finance cost is supposed to be 400. Okay, so you can either take that 400 as it is, but I am doing the changes for you all to reflect it well. So what were the adjustments we did? 7 7 16 payables changed, finance cost changed. Okay, that's working note number 1. Was that too much? Was that too many items? Have you
Another question.
can I have a look at the question that you've run? This first question. Any second question? Okay. Right. Then comes working note number 2. Inventories are 30th June 20x2. So they've given inventory 30th June 20x1. Are there any other inventories they've given in the trial balance? No. Right. Again, this 7 million is going to be apart from whatever is there in the financial statements. We missed to take the financial statements, share premium and share capital. This is the share capital plus 7 million. Share premium, this plus 7 million. Okay, that's share premium. And retained earnings, they've given retained earnings. For the moment, we know the retained earnings figures. We just copy and paste it here. That also scores you marks. Right. Then we will have to add the relevant profit here, right, after making the adjustment. Okay. Working note number 2. What's the working note number 2? The relevant applicable standard is IAS 2. When you take IAS 2, what comes to your mind? Lower of cost or NRV, right? Okay. What is, now we need to understand what is the cost, what is the NRV. Okay. So let's see. Cost, NRV. Let's do that calculation quickly. What's the note saying? 700 with a cost of 1400 per unit. Cost is 1400 into 700. That's the cost. Okay. And then the NRV is 1600 minus 400. 1600 is selling price minus the cost to sell. That's the NRV, right? 600 minus selling price, or selling price minus cost to sell. Selling price minus cost to sell into 700. Okay, what is lower? NRV, right? But what are they saying? The question says inventories were initially valued at total cost of 5.7 million, right? So what has happened here? 5.7 million closing inventory. Now there needs an adjustment. What has been done? Inventory they have recorded as 980. Where does the other transaction impact the inventory? The closing inventory impacts the cost of sales. Cost of sales has been minus 980, right? What should have happened? 840 and minus
Can
840.
you show how did you got that NRV?
NRV 1600 minus 400 into 700. Okay. Right. So what's going to be the adjustment that's required? So you will have to reduce the inventory by 140 and increase your cost of sales by 140. Clear? Right. So that is going to be the cost of the note number 2.
It's easy to do in this way.
Hmm?
It's easy to do in this way.
Yeah.
I mean, this way forward.
Yeah, this format is easier, right? Yeah. So whatever needs to be in your head can come into paper if you are good with managing time. Okay. Right. So inventory 5.7 million is what they are saying is there. No, 5,700 minus 140. Then here the cost of sales. Yeah, they had given cost of sales here.
So we can get another working.
Hmm? Hmm?
So depreciation part.
Wait. Production cost is the cost of sales. So they've given the name as production cost, right? This plus 140.
So we have created working for cost of sales. Depreciation is comes under cost of sales.
Oh, there. Okay, so we'll do the cost of sales working shortly, right? We'll do another working for cost of sales, okay? But we'll first finish that's why I always finish the notes first, then I do the final estimate. That way works better. So let's do it in that way itself, right? So the working note number 3. Right, working note number 3. At 30th June 2022, Printco has a contract to purchase 22,500 electrical components over the next 3 years at a cost of $450 each. These purchases are made at a constant rate. These components are no longer required for their initial purpose but do have an alternative use, which will require additional manufacturing cost of $600 per component. Thereafter, each component can then be sold for $900. Alternatively, Printco could cancel the contract immediately by paying a penalty of $4 million. Any adjustment resulting from this information should be made to administration expenses. Ignore discounting. So whatever they say, you have to consider that. What are they saying? They are saying it should be dealt with under admin expense. When it needs to be dealt with under admin expense, you need to do it under admin expense, right? And when they say to ignore the discounting, meaning you are supposed to ignore the discounting. Don't go to consider that. Okay. Right. Now, what is the standard? Can you tell me what the standard is? 15. Just a part of 15 can say. But where does it mainly belong to? Anyone? IAS 37, onerous contract. What does onerous contract say? When you talk about onerous contract, what should come to your mind? Lower. You need to reduce your losses. Therefore, it's going to be lower of cost of fulfilling the contract and terminating the contract. Whatever is going to reduce the losses is what you'll be taking here. And that's what the working note number 3 says. Clear? Now there what needs to be done? What is the cost of, now here you have to see what is the cost of terminating the contract. They've given that. What's the cost of terminating the contract? 4 million. What's the cost of fulfilling the contract. Cost of fulfilling the contract. Now to do that, you have to do a working. Okay. Right. What are the total costs involved here? Go back. At a cost of 450, what was the initial cost? Initial cost 450 per unit. 450. Take that cost into consideration. Then they are saying this purchase made a concentrate the component no longer required for the initial purpose but do have an alternative use which will require additional manufacturing cost of 600 per component. Additional cost. Or you can call it conversion cost. How much? 600 per unit. So what's the total cost? Plus this 1050. What is the selling price? What are they saying? Component can be sold for 900. Now they can sell for 900. Selling at a loss, right? So what is the loss per unit? This minus 150 the loss per unit, right? How many units? Number of units 22.5, right? What's the total loss? Total loss how much? This into. So what's the cost of fulfilling the contract? What is lower of both? Lower of both, cost of fulfilling the contract. Now when there is provision, now they are saying this is dealt with under admin expense, right? Okay. Here we forgot to mention the statement. One. Why is it hard? You can reach out to me. I can help you out. If there's anything that's difficult, we can have a one-on-one conversation, maybe half an hour, 1 hour. I can explain to you whatever the questions you have. Okay, don't worry. Right. So now when there is provision, how that's going to impact? It's a liability, right? Provision will go as liability as well as admin cost. Okay. Now what they are saying, next 3 years. So liability is also going to be split as current and non-current, right? Okay. Provision, liability. Provision, NCL provision, current liability provision, and there is admin cost. Okay. I need to move this working. So for the moment, I'll just erase this working out, right? 3375. So we have the figures 4000 and 3375, right? 4000, 3375, cost of termination, cost of fulfillment, right? Okay. So now this is what you are going to deal with under statement of financial position, SFP, and this is going to be under SPL. We will have to do admin cost working as well as the cost of sales working. Okay, we have to do both of those as well. How are we going to see how much is going to be? Now what has been done? There was nothing done here, no? So 0, 0, 0. What should have been done? Out of 3 years, 2 years is non-current liability, 1 year is current liability. Why? Because 1 year is what you are going to consider as a current liability into 2 divided by 3. Current liability is going to be this divided by 3. Okay, that makes it a total of 3,375. Admin cost, there is going to be 3,375 cost that you have to increase your admin cost by. Okay, clear? Working note number 3, is that clear? Was that difficult? Was that difficult? No, right? Unit cost. First, we figured out what the cost of terminating the contract was. Then, what is required? 100% content coverage. Only then you know it's going to be lower of cost of fulfilling and cost of termination. Cost of termination we had. Cost of fulfilling, how do you find out? The initial cost plus the conversion cost. That'll give you total cost minus selling price. Yeah, they have to give termination. So you, only then you know which one is going to be lower. Okay. All right. In case they do not give anything, only one figure is there, you have to use that one figure. Okay, remember that. But generally they will give it. Working note number 4. Right. Some challenging standards are being tested, no, in this question. See? Right. What's the standard? On 1st of July 20X1, the directors of Printco decided to sell a piece of machinery and the asset met the criteria to be classified as held for sale at that date. The machine, which cost 2.4 million, had a carrying amount of 1.5 million at 1st of July 20X1. At that date, its fair value less cost to sell was 1.14 million. The machine was sold for 1.1 million after selling cost on 1st of July 20X2. No adjustments have been made to take account of classifying the machines as held for sale. At classification, what's the standard? IFRS 5. When it comes to IFRS 5, you know, when you're classifying, you have to classify it at lower of carrying amount and fair value less costs to sell, right? And then what do? Once you've classified, you stop depreciating. Then what do? You have to recognize it as a current asset. Okay, current asset as a non-current asset held for sale. Okay, so that's what you need to remember. So what are the components? First, there is going to be a non-current asset component that's going to be affected. Then current asset held for sale component. Then there is going to be cost of sales, right?
This is a word Excel.
It's happening. Something wrong. Anyway, right? Some technical issues. Don't think too much about that, right? So there's been nothing done here, right? Now they're saying there has been nothing done about this, right? So what you need to do is you need to figure out how. Now you have to do working on figuring out what has been the fair value, what has been the impairment, what has been the non-current asset that would be remaining as non-current asset, what non-current asset will go as a current asset. Okay, right. Now let's do a little bit of working here. All right, carrying amount at 1st of July X1. Why? What happened on 1st of July? The directors decided to sell a piece of machinery, met the criteria, right? So on 1st of July, you are reclassifying. So on that date, what was the carrying amount? What was the carrying amount on that date? 1.5 million, right? 1.5 million was the carrying amount. What was the fair value less cost to sell on that date? 1.14. So what has been the impairment? But what was the price at which it was sold? 1.1 million, right? So on that date, fair value less cost to sell at 1st of July X2. How much was that then? 1.1 million. So what's the additional impairment? Minus this 40. So what's the total impairment?
So why are we taking the previous year's figures?
Hmm?
We are taking the previous year's figures.
To identify how much by how much was it impaired. Now fair value less cost to sell anyway is going to bring down the carrying amount. No. Now how when it was sold, how much further it went down, right? When they classified it as held for sale, what was the value that they thought it will be sold at? But then what was it sold at?
The 40 will be on a statement of
Hmm?
that impairment loss of 40, only the 40 will be.
Yeah, but why is this required now? That is going to impact our SFP, statement of financial position. Statement of financial position is an accumulating financial statement. We'll come there, right? Once we come there, it'll be clear, right? Okay, so under current asset, what's going to be the value you are going to record it at? What's going to be the value the current asset will be recording at? Hmm? Okay, 1.1 million. Non-current asset, we'll have to do another working. Now you see how many workings we have to do within the workings when it comes to such questions. We have to make a PP schedule. These all can go as workings, huh? PP schedule. You have non-current asset, the cost, right? So cost there is going to be brought forward cost, right? Then there is going to be eliminations, any eliminations or changes. Let's call it changes to cost, right? Then you'll arrive at carried forward cost. Okay. Land, plant and machinery are the two assets that they've given, and then you have total. Okay, right. And then what else do you have in your PP schedule? Accumulated depreciation, right? Again, accumulated depreciation, there is going to be brought forward depreciation for the year, then elimination, right? Here also let's go as elimination. Disposals, elimination meaning could be for disposals, right? Right, then you have additions that you can add, but there's no additions here, so we're not going to take that into consideration, right? Then you will have a carried forward, and then you'll have your cost minus your accumulated depreciation will give you your carrying amount. That is going to be your PP schedule. Land, what has been the cost of land that they've given here? Cost, land at cost 45,000, right? Plant and machinery at cost 16,200, right? Sorry, let's move BF here, okay? Because I have got it there. Okay, cost, right? How much elimination you are required to do? So in this case, you won't call it disposal, you would call it held for sale. Reclassification. Cost. Disposing an asset, you have to remove the cost. You have to remove the cost, you have to remove the accumulated depreciation. That's what happens when you are, reclassifying or disposing, right? What is the cost? 2.4. Very good. See, those are intricate details you need to remember. Okay. Carried forward, there is no change here. Carried forward, there is a change here. There you go. Accumulated depreciation, land is never depreciated, remains 0. Plant and machinery will be depreciated. What was the brought forward plant and machinery? They've given it here, 7290, right? And then how much is the depreciation rate? Depreciation rate, they are saying, what's the depreciation? When on 1st of July, directors plan to sell, right? 30th June 20x2 is when you are going to bring the depreciation, right? Now tell me, which figure are you going to now? What is the depreciation rate here? What's the depreciation rate? Have they given? Depreciate plant machinery at 15%. Note number 5. Depreciation 15% per annum. So what will you depreciate? Will you depreciate the cost or will you depreciate the carrying amount? Carried forward amount of cost. This, right? Held for sale is not depreciated. So your depreciation for the year needs to consider the assets without held for sale assets. So that is going to be the carried forward amount here, right? That into 0.15. That is your depreciation for the period. Okay. So what is going to be the held for sale accumulated depreciation? How much is the held for sale accumulated depreciation? How much is that? How do you understand? Umar, tell me. What's a held for sale assets accumulated depreciation? IA 16. How do you identify that accumulated depreciation? No idea? No idea? Difference between cost and the carrying amount. Cost minus accumulated depreciation is carrying amount. So when there is no accumulated depreciation given, obviously it's going to be the difference between cost and carrying amount. Why are you confused? Too much of information? Is it? Don't get confused in the exams, please. Be very careful in understanding, right? Minus. That is the held for sale. What's going to be the carried forward amount? Plus this minus this. That is the carried forward amount of accumulated depreciation. What's the carrying amount? This minus this. 5,340 plus 45,000. So what's the total non-current assets? What's the total non-current assets? And this cost of sales is going to be the depreciation for the year plus impairment. Okay. Right. Was that clear? Too much? Was there too lengthy of an information set that had required a lengthy working? Is it? Now working 5 also done, na? Within the working note number 4, we have done the working 5 also. What is it? The depreciation rate. Finally, working number. Now let's do it. Working number 5. Final working. What's the final working? The income tax refund for the year has been estimated to be 2.53 million. Tell me what's the standard applicable? IAS? IAS 12. Right. Now, what is this? How is this going to be impacting your financial statements? How is this going to impact your financial statements?
Tax.
Yeah, so SPL, you're going to deduct the tax. And statement of financial position under current or non-current what? Current what? Current liability. Current asset. Very good. So don't get confused. The question is confusing you all. It's a refund. So it's not an expense. It's a current asset. Deferred tax asset. Right? SFP. And then income tax refund. Income. SPL. $2,530. There we go. 2530. Is that clear, guys? They'll get confused. They'll get confused. No confusions, sure.
It's time for 10 days.
Why? Huh?
Flood.
Huh?
Flood.
Right. So you've not studied. Done with mock? Are you following the 30-day planner?
Working more than that now for 3 days.
No worries. As far as we are covering, we are good. We are in a good position. Okay, don't worry. If you need any help, I am always there. I'm always available to help you out. Don't worry about that. If you need any particular guidance, reach out to me, okay? Because I know that inshallah you'll be able to get through. Right? Right, now let's do a couple of more workings. We're going to do cost of sales working. Right, cost of sales, what's going to be the working? Opening inventory. Then there is production costs. Then minus closing inventory. What else goes to cost of sales? Did this depreciation goes to cost of sales, right? Right. Machine. Right. And held for sale impairment. That also will be going under cost of sales, right? Right. So how much is the opening inventory? They've given the opening inventory here. Opening inventory, we can select from here. What was the production costs? 6150 equals 6150. Then closing inventory. How much is the closing inventory? How much is the closing inventory? Where did the closing inventory go? This, right? That's add what?
Working.
Which working? Depreciation. Yeah. Yeah, that we are doing right now, no? That I just took. The closing inventory I just took, no, 5560. Yeah, that is this working rate you are talking about. 5700 minus 140. That's what you're saying, no? Clear? That I've taken. 5560. Okay. How much was the held for sale impairment? 400. How much was the depreciation? 2070. Right. That's what we see. 2470 goes to cost of sales, right? So what is the updated cost of sales now? Will sum excuse me guys. Right, okay. Right. So what's going to be the total cost of sales? This is going to be the total cost of sales. Okay. Right. Then what else? What's the other working that we have missed to do? Admin cost, right? Admin cost, do we need a working to do? Just we can add it, right? Okay. Admin, we can directly add the 3375. There's no working per se. Right. So cost of sales equals this. What's the revenue? Equals 97,400. GP, this minus this. Admin expenses. How much is admin expenses? They have given in this. This is admin expense, right? 29,570. And then we had to add the provision, right? Distribution cost. How much is the distribution cost? Directly from trial balance itself. Right. Finance cost also we have the figure. Okay. Then what else? Income tax refund. How much is that? Right. Right. So we can actually break it down a little bit. Finance cost. Right. Hmm? 1 minute. Profit from operations. That's going to be this minus, sorry, GP minus admin cost minus GP minus admin cost minus why is it not allowed? This. Yeah, that's the not profit, it's a loss from operations. Huh? Why it's negative? Right. Then loss before tax refund. This plus this tax refund. Then there is going to be net loss. Minus 4. There you go. This is your statement of profit or loss. Okay, the net loss of 4,525. Then you can do the rest of the adjustments of your statement of financial position, right? Nothing hard and fast there. So NCA, there is going to be PPE. We have that figure 5340, right? Then the current assets is where we have the rest of the figures: inventory, trade, and other receivables. All right, trade and other receivables. And then there is bank, there is tax. What else? Held for sale. Very good. So held for sale usually goes down, right? So we'll just put one more line here. Add one more line and put it down. Held for sale. How much? There we go. Right? Trade and other receivables, we can directly take these figures from the trial balance itself. Where do we have the trade receivables? Right. Bank, how much is that? 4,700. Tax, we just saw, it's 2,530. Right. So current assets equals sum that's the current asset.
So can you share this Excel sheet?
Okay. This is the non-current asset, right? Then non-current liability, we have bank loan, and then what else do we have? What else do we have? Provisions. Provisions. How much? 2,250. Then current liability, we have provisions. How much is that? 1,125. Right. Equity, what else do we add? 11,470. And there's a gross loss, right? So minus 4,525. That's equity. So what's the total equity? Right. This plus, I hope it balances. This plus this. Perfect. How was the question? How did you find the question? Was that difficult? So, but had you referred to it, had you had the 100% content coverage, it would have not been a difficult question, right? Challenging, yes, it's tricky for sure, but not challenging. Okay. All right, guys. So, any questions before we wind up? Any questions before we wind up? No questions, right? So that was March, June 2022 questions for y'all. I hope it opened your eyes to different possibilities of questions being asked. So make sure y'all practice more and more questions. And right now, what I'll have to do is March, June 2022 examiner report. Read that. Let me show you how to do that. Right? Full screen. ACCA FR March June 2022 examiner report. There you go. I want you all to read this examiner report right now. Soon after we complete, there is going to be section A questions. Just ignore those section A questions. Directly move into section C. Read those, then read the section A questions also. Okay. From here, start from here, section C. Read this entirely. Once you're done reading and understanding, come back to the beginning and look at how the section A questions were and what were the challenging areas. Okay. That's how you keep in track through your examiner's report. All right. So I'll see you all on next Sunday. Until then, stay safe, take care, have a great week ahead, and happy learning. All the best. No worries, Azmat. Your marking scheme question. There is no marking scheme per se for this. But in the practice platform, once you're done with the question, you will be able to self-mark it. When you're self-marking, you'll be able to check the answers there. All right?
Yeah, but I couldn't find the self-marking part. Like, they didn't show the answers. Did they show the answers?
Okay, let me show you how the self-marking works. Okay. There's a different lecturer's question. So okay, I'll just show you how to go and self-mark. All right, go to exit. There is a mark option here. In that, FR, whatever the question is, will appear here. You click that self-mark, right? When you click that self-mark, that will take you to questions and the answers. Okay, this is the question that they're showing. Okay, that's a question stem that they're showing, right? Okay. Marking guide. So here the question sample answer. You click here, you'll get the sample answer. Okay. You click here, you'll get the marking guidelines. Okay. There you go. All right. Is that clear, Azmat?
Yeah, got it.
Perfect. All right, then I'll see you all on next Sunday. Keep preparing well. Any questions, do reach out to me. All right. I'll see you next week.
Yes.